Hey guys, what's up and welcome. In this video, we've got a two-piece. The economy's getting pretty bearish, guys. We've got Komal Sri-Kumar saying the Fed is totally out of control and doesn't know what to do next. That's not good at all. And we also have JPMorgan's Meera Pandit saying, I wouldn't take another rate hike this year off the table, guys. So we're going to have some pretty good spicy videos to hop into. As always, if you enjoy the video, please smash that like button. I appreciate you being subscribed, and let's jump into them.
With the 10-year Treasury above 5% for the first time in 16 years, let's bring in Komal Sri-Kumar, president of Sri-Kumar Global Strategies, and get his view on what he thinks is going on. Sri, and I know you watch, and we've been talking, we've used terms like untethered and unmoored, and I think that's what you want to focus on, because there could be some, I guess, somewhat disturbing outcomes if the Fed has lost control of its ability to set long rates. We've never believed they could set long rates, but for a while it looked like it was all orderly. They haven't raised rates in a while, and we've had, what, 80 basis points, 70 basis point increase in the 10-year. That could be troubling. It is to you.
Absolutely. I put out a report on Saturday, Joe, saying precisely that for the first time, you have Jerome Powell, who has never been doubtful as to what he did, even though he has been sometimes wrong on expectations of inflation and interest rates, finally said in his Economic Club of New York talk, as well as in the Q&A session, that he did not know what is causing the higher bond yields. He attributes that to term premiums. The term premiums are not measurable. And therefore, essentially, the Fed chairman comes down to saying, I don't know what it is. And when he said that, I said, we are in completely uncharted territory. Things are going to get worse next week because of the fact that the Fed is totally out of control and they don't know what to do next.
Guys, if the Fed is out of control and don't know what to do next, there's going to be massive inflation. The stocks are going to start panic selling because the rates are going to keep going up, and everything is directly correlated, guys. With him coming out and basically saying he's out of control, he's letting us know, guys, this can get worse really fast. Maybe even like a Black Monday type of deal. I hope the economy does not have that.
So you are absolutely correct. I think unintended consequences are going to happen. I've been saying that on your show for quite some time. Whether it be a huge bank failure, whether it should be pension funds losing a lot of money, commercial real estate suddenly worsening, or a CLO, commercial loan market, and levered obligations having difficulty, somewhere things are going to break. And rather than expecting 3 to 6 months, I'm going to say within the next 4 or 5 weeks.
Sri, individuals that are more sympathetic to Chairman Powell's plight have actually said that this was totally Chair Powell's doing and exactly what he wanted, and that when he said higher for longer in recent appearances, that he said it better, or said it in that he actually stimulated yields to go higher.
To me, every time I've been hearing higher for longer, to me what he's saying is that we're going to stay at the rate, at the constant rate we're at for higher for longer. We're not going to keep going higher for a longer amount of time. If that's what he's been saying, or if that's what this starts to turn into, everything is unchecked. The stock market tries to price things in, we'll say a year to 18 months in advance, and we do not have that priced in. Let's just say that.
And it was exactly what he wanted, and he kept saying higher for longer, and that he orchestrated deliberately this move up to 5%. And I don't know, we've been saying higher for longer for 7, 8, 9 months. And suddenly we're almost not inverted anymore because of what's happened on the long end, Sri.
There are 2 points in response to your the issues you raised, Joe. They are very relevant. First of all, yes, he wanted inflation, the interest rate to be higher, the yield to be higher, but I don't think he wanted it to go well over 5% as it's done again today. and in that rapid fashion as he has done it. Second, if he is looking for yields to stay that high and to go up that rapidly, if that was his intention, he also must be intending to create a train wreck, meaning that he is going to cause something to crash. And if you tell me that is part of his intentions, then he's right doing exactly what he wanted to do. But that's not, I'm sure that's not what the chairman wants. What he wants is a mild increase in the unemployment rate. He wants the job opening rate to come down. He wants the inflation rate closer to the target, but otherwise the economy moving smoothly. But that's not what he's going to get. There is no via media between too much excess and crashing if you follow a policy of this kind. When the bond yields, you said they are not controlled by the Fed. That is true. But today he has totally lost control of them and not able to influence them. And that is a lot more serious.
Guys, if he's out of control, it is going to be a massive, massive problem. We cannot keep raising rates. These banks have already gotten together and all written letters to the Fed saying, hey, we cannot keep this up, especially at the rate that you're hiking. So something is going to have to give, and please don't kill us, is basically what the letters were getting at. So it's not looking good.
Yeah, I don't know what breaks, and we could do a David Letterman top 10 list. He used to do I guess he was at one point a late night host of a show.
I remember that.
Now he hasn't shaved since he left, I don't think. But but the top 10 list, so it could be commercial real estate, it could be it could be another bank, it could be a lot of different things, but it's scary. But for whatever it is, and there's no guarantee that you'll be right on this, but you could be. But you think that shifts the Fed to easing quicker than anyone anticipates at this point? When do you expect that? So you think within 6 months we could be back on an easing path or a rate cutting path, Sri, within 6 months?
Yeah, Joe, just look at last March to give yourself an indication. We had 3 small regional banks which failed. And immediately quantitative tightening ended and quantitative easing was put in place. We took the Fed assets back to November of 2022. We set it back by 5 months. What I'm saying is if that incident could do that, anything like a bigger crash taking place in the next 2 to 3 months is going to completely reverse monetary policy in terms of both interest rates and quantitative tightening. And yes, within the time period that you mentioned is clearly when I think it will happen. 2024 is going to be a year of lower interest rates and clearly a much more easier Fed than we have seen so far.
I don't know whether that's good or bad. I mean, we have had, the sort of the specter, the possible, Rick is.
Nobody knows if it's good or bad. We're in uncharted territories, guys. We're going to have to ride this out and see if this was some of the best moves possible back when we're looking back at history, or if Jay Powell was totally out of control and doing all of the wrong things. It's one of those things where we're not going to know into the future, and it's going to be a little too late if you're trying to put money to work today, or you want to wait until then. Markets could be way past all-time highs if things start looking good. They can also be well past the 2022 bottoms if things keep getting worse. So it's a hard time to put your money in the market right now for sure.
Mentioned some things. If you look at a chart, much higher rates could be in the cards than what we're seeing. At least in this case, it sounds like maybe where there's going to be some turbulence on the way, but it would keep us from getting up to 7, 8, 9%
exactly
anytime. That won't happen, you don't think, in the next 5 years even?
That's exactly what I'm saying. That yes,
okay,
you may want higher yield to restrain the economy, but you cannot do that without wrecking something, without breaking something within the system.
Because people got too used to that. We were there. There's people 30 and 40 years old. They have no idea that rates can go above like 5%.
We don't ever need to know that they can go above 5%. We do not want to feel that. Trust me. That is the Fed's job, to keep us away from inflation, keep us at easy money times. Maybe not free money, but at least easy money. And we went from free to hard. So there's a lot of gray area in between that we can start working with, guys. Now we're going to jump over to JPMorgan's Meera Pandit. she wouldn't take another rate hike off the table this year. That does not seem good for stocks, guys.
I was Meera Pandit, JPMorgan Asset Management Global Market Strategist. Good morning to you. You've been listening to this conversation. Do you want to weigh in on this piece of it?
Absolutely. I mean, I think that it is a question of control versus what the Fed is finding convenient. Because if you look at the short end of the curve,
right,
in terms of two-year yields, they really haven't moved a lot recently. So in that sense, they're pretty well under control in terms of garnering short-term rates in the area they want. The issue is the long end, and with them stepping back as a major buyer, there's really only one way that they can influence the curve, and I think that the big issue at the long end of the curve is the big existential issues in terms of supply, federal finances in the long run, and how we actually finance the deficits that we need to at higher and higher rates, and who's going to be the buyer given some of the uncertainty around that. So I think right now it's very convenient for the Fed in terms of further rate moves that you have the long end move higher and doing some of the work for them, tighter financial conditions. The question is if they do want to ease back on some of that restrictiveness.
What's your prognostication at this point about what they do next and when, if they're going to do something?
So the yields are starting to do the work for the Fed, but now the Fed is saying, hey, we can slow down, and the yields are saying, nah, bro, we're going to keep going.
Let's not take another rate hike off the table. I know that people came out of last week thinking that Powell was very dovish, but I actually heard a very balanced view of we're in restrictive territory, but further rate hikes might be necessary, but there's further tightening
calendar year?
Potentially in December.
Okay.
I think that if
you think in November off the table at this point?
At this point, I don't think there was strong enough signaling to say we were going to do one more rate hike soon. But it was only a month ago that most of the FOMC participants saw another hike. So all of them changed their mind in the last couple weeks.
Could a really strong GDP number change that? I mean,
potentially. I mean, we've had a string of strong data. I think the real GDP numbers that we're likely to get later this week have been well forecasted for months now that this is going to be a really strong print. When you add on to that higher CPI, higher jobs, higher retail sales.
Yeah, but 4.5% for the consensus versus 5.4% or whatever it was for the Atlanta Fed. That's a big difference. If there's a number north of 5%, I would think that that would potentially change the scenario.
I don't know if it'll change it for November just because it seems like they want to not catch the markets off surprise, especially when markets have actually taken down their probabilities of a hike in November. But I think that they could start signaling for December more strongly. But look, the economy usually goes at 2%. So whether it's 4% or 5%, yes, that's a big difference. But we're basically looking at double normal growth.
What did you think about Powell's comments last week where he effectively, I thought, was saying, look, I'm not that worried about most homeowners. I'm not really worried. I mean, he didn't say I'm not worried about a 2008 crisis, but he was saying basically in terms of mortgages and the like, because people are locked in, that there hasn't been any real movement. The problem is that you're affecting new buyers and you're affecting durable goods orders and things like, automobiles. We heard Elon Musk and the like. So how do you think he's thinking about those sort of two sides of the coin?
Well, it's interesting. On the one hand, he said, I think some of these long and variable lags are not going to be as long and variable because the central bank can well forecast things and markets can price it in. On the other hand, you look at things like mortgage rates, you look at things like companies issuing debt and how far they've termed things out. These lags could actually be much longer this cycle because of how long people have locked things in. But he also nodded to the fact that
Guys, again, that's such a balanced report. He's talking to only homeowners with mostly people that have their house paid off or locked in at a low rate. That has nothing to do with this up-and-coming generation that all has to buy their house for the first time at this crazy rate and it can't get around it. The people that just got a new job in a different state and have to move and can't get around it. The people that are just having to move anyway and get a house. Any natural disasters that happen to their house. Any insurance claims that happen to people's houses and they have to move. They are forced to get these houses at outrageous rates, guys, which is going to slow growth everywhere. If people can't move, they can't continue to be productive, they can't make money to spend money, and it's just a vicious cycle of negative.
Headed towards an era of supply shocks. And I think that's a big one because ultimately when we think about housing and the lack of housing supply and many of the other supply issues, geopolitically related, commodities related, the question is, are we still in this pandemic aftermath where we're kind of getting through some of that, or are we going to see more concerted supply shocks in different areas over the next several years? Is that going to change how they think about that neutral rate?
Which camp are you in?
I think that we might see on the margin a little bit more on the supply shock. I mean, the housing issue is a big one, I think, when it comes to inventory.
We got to run, but finally, are you surprised, and we haven't really even talked, we talked a little bit about Israel and Hamas this morning, but is there any risk baked into the situation of just what's happening in the Middle East and how far that?
I'm interested to what she says. My opinion is yes, there's risk, especially because there's reports coming out this morning it's going to get much, much worse before it might not even get better. It's just only going to get much, much worse right now in the short term is what they're saying. So I'm interested to see what she has to say.
That could go.
I think that broader conflagration clearly will be an issue if we have more regions being brought in and that affects oil prices. Right now, because things are contained, we want to monitor it, but it doesn't seem like an immediate risk. But these things can get out of hand quickly. So we want to continue to monitor that tail risk.
All right, guys, just to wrap this up, we want to keep an eye on the Israel conflict. We want to keep an eye on rates. We want to keep an eye on Jay Powell and his comments. We want to start to hear him say that he has not lost control, that they have found a way to manage these long-term rates, even though in the past they haven't been able to. We need to hear Jerome Powell say we are not going to rate hike anymore this year or even ever. At this point, I think we're up high enough where we just need to stay higher for longer. In terms of staying the exact rate we're at for longer, not keep getting higher for a longer period of time. The economy is already starting to feel the effects. I don't even know if we can stay at the rate we're at for a long period of time, much less keep going up and then keep that rate higher for longer. The stocks are already starting to fall. We've already been pumped up with stimulus, guys. We can't put more stimulus in. We've already knocked off so many things that we can't do to help this economy, and it's still getting worse. I hope you guys enjoy the video. Just some of today's thoughts. Keep it in mind that it could be a little bearish. Maybe keep some powder on the side dry. If you enjoyed the video, smash that like button, lets me know, and I'll see you guys later on or tomorrow. Peace.